Hey, what's going on, traders? So your next lesson is going to be on dividends, right? So every company, when they make a net income, when they make earnings, right, they have to have an understanding of how they're going to divvy up all that money. So some of it's going to get reinvested back into the company for growth. Some of it's going to go and pay some debt off. Some of it's going to be repaid back to their shareholders in what's called a dividend, right? So different companies offer different amounts of dividends and how much they pay out to different companies or to their shareholders. In essence, a little payback in how they invested into the company. Now they're getting paid back a little bit of that income or some of that net income that they actually profited from, right? So the biggest thing about dividends, you have to have an understanding that there's four main dates that you need to know when it comes to dividends, right? So the first one is going to be your declaration date. A declaration date is a date on which the company's board of directors announces its next dividend payment in the date as well as the amount of, right? It's also known as their announcement date. So they announce at this time in the quarter, we're going to pay X amount of money by this specific date, right? And they also announce the other dates that's involved, right? One of them being the ex-dividend date. So the ex-dividend date is the date in which all shares bought and sold no longer come attached with the right to be paid dividends. So you have to own the shares before the ex-dividend date. So if the ex-dividend date is, let's say, tomorrow, you need to own the shares by today, by the close of business of the market hours, to qualify for dividend payout. Then the next date after the ex-dividend date is the date of record. So that's when the shareholders who properly registered their ownership on or before this date will receive the dividend. So the bookings, the company accountant goes through and say, okay, the data record, this is the data record. Everybody who owns shares by this date, which is usually 2 days before the data record, qualifies to own dividends, or at least to get paid dividends, right? Whether it be the dividend reinvestment and you're getting put right back into shares, or you're going to get a cash dividend in essence, right? And then the last date is going to be your payment date. Your payment date is obviously the date of either when they're going to reinvest it back into more shares of the company, or they're going to put the amount credited to your brokerage account, right? Or they might mail you out an actual check, a dividend check to your house if that's how you're getting paid out. Depending upon how you're going to get paid out, that payment date is when they actually send out that payment. So whether it's credit to your brokerage account, whether it's to reinvest into more shares, or they actually mail you out that check, right? Now, the yields, right? Dividend yields. So there's always a percentage. Dividend is always expressed as a percent, but the dividend yield is always fluctuating depending upon the price point of the stock, right? So if the stock is said has a 4% yield when the stock is at $100, then as the stock goes up, that yield actually goes down, right? Or vice versa. When the stock goes down, the yield actually goes higher, right? So there's a payout, there's a dividend payout, as well as a dividend yield, right? So it either is structured as a percent or it's structured as an actual dollar amount. So let's say if I own XYZ stock, the stock has a $2 payout, right? And the stock is currently rated at $20. That would give me a 10% yield, right? But if I have a $2 payout, as the stock goes up to $30, that yield in essence drops to like 5% or 7.5%, whatever that actual math is, right? But yet if the stock goes down in price to $10, I'm in essence getting a 20% yield, right? So the yield actually fluctuates depending upon the actual price point of the actual stock, right? And then the amount of money is the amount of money a company pays shareholders for owning a stock is inside its actual dividend yield, right? Now, when we go through and we understand that, okay, we have a payout ratio. So when you go through and look at the books on different companies and they say, hey, we have a 100% payout ratio. Why that sounds extremely good, you have to understand that the dividends come from their net income, right? So all the profits that the company makes, so if they say they make $100 million this quarter and they have 100% dividend yield or 100% payout ratio, that's saying the whole $100 million that's profitable is now going back to the shareholders. Well, that seems good for the shareholders, but what's the future investment, right? What is the future investment that the actual company has to do with, right? So the payout ratio is a big proponent of actually if that company's dividends is good, right? Because a too high of a payout ratio basically tells you now that how is the company going to reinvest into more growth or more expansion or pay off debt and so forth, right? So the payout ratio, just like it says here, the ratio of the total amount of dividends paid out to shareholders relative to the net income of the company. So like I said, if the net income of the company is $100 million and the payout ratio is 100%, they pay out 100 million divided by all the shareholders, right? By all the outstanding shareholders. Now, if the payout ratio is 30%, then they're going to pay out $30 million to all the shareholders, divvy up that to however many shareholders they have, while they have the other $70 million to either reinvest into the company for future expansion, growth, acquisitions, or whatever the case may be, as well as to pay off debt, right? So payout percent actually means something. So you have to do your due diligence. You have to understand how much are they paying out and where are they reinvesting that other money, right? So the percentage of earnings paid to shareholders via dividends, the amount of earnings not paid to shareholders is retained by the company. So like I said, if they pay out 30 million of the 100 million of net income, right? The rest of the money is retained by the company to either pay off debt or reinvest into core operations or acquisitions or something of the sort, right? So how they determine the actual payout ratio is the dividend payout ratio equals the dividends paid divided by the net income. In essence, 30 million paid divided by the 100 million net income is 30% payout ratio, right? So another thing about the payout ratio, it also tells you the maturity level of the company. So if a company is maturing over time and their payout ratio is consistent or growing and they're reducing their debt and they're still able to expand, it lets you know that the company is doing extremely well for itself, right? So it continue to grow, could continue to expand, continue to reinvest into their shareholders and pay their shareholders money, like a Coca-Cola or Procter & Gamble or something of that sort, right? So newer companies reinvest most of their earnings back into growth. That's why I said the level of maturity, because as the companies are continuing to grow, they need it to continue to expand all their net income, right? So they're taking on a little bit more debt, they're paying off their debt, they're paying for research and development, they're paying for more factories, they're paying for more products and so forth. So newer companies, growth companies, tend to have a much smaller payout ratio, right? Versus more mature companies or well-established companies, right? Now, what is a good payout ratio, right? So when you look at companies that pay 70% or higher of the payout ratio, it's usually let you know that they're paying too much to shareholders and they're not reinvesting the company or the money into the company, right? Or they're not paying off debt or so forth, right? So a lot of times you look at a company like AT&T. Why they have a very high dividend, they also have a very high debt, right? They owe like 120 billion, some crazy number like that. So won't they reduce their dividend payout percent and increase and start reducing their debt, right? So a lot of people think that that's what they should do, but they also are very attractive because they have a high dividend yield as well as a high dividend payout, right? So a lot of people are attracted to that, so they continue to invest. So it's a give and take, right? but an ideal percent is anywhere between 30 to 65% payout ratio is usually pretty good. So this way the company can still, like I said, continue to grow, as well as continue to either build up their cash funds for future acquisitions, as well as make sure that they maintain a small amount of debt or pay the debt off, right? Now, one thing is REITs, real estate investment trust. They usually have a very high dividend payout ratio of 90% or higher, sometimes 100%, 110%, and so forth. And the reason for that is because they're legally obligated to have a minimum of 90% payout ratio, because they also get some special tax exemptions, right? But if you go through and you see a company have 90%, 100%, 110%, it's hard to sustain that, because how is the company going to continue to grow, continue to develop, and so forth? So that's why that 30 to 65% payout ratio is very like prime amount that you want to go through, right? 30 to 50%, 65 still kind of high, but 30-50% payout ratio and a more mature company is very well established, and it's good for long-term perspective, right? Now, there's also special dividends as well. Now, what special dividends are is, let's say a company does their census is they expect to make this amount of net income, right? And they already allocated this 30% payout ratio to dividends, this 40% to pay out for debt, and this other 30% to pay out for future growth. Now, if they make more than that, 110 million, versus why they thought they were only going to make 100 million, right? That other 10% sometimes go back into special dividends, which is a one-time special dividend payout for dividends for the shareholders, right? And so forth. So that's usually pretty good. That's usually when the company does extremely well in a quarter or in their annual net income, and they have extra money they wasn't accounting for, and then they give a special dividends to their actual investors, which are their shareholders, right? So now the other thing is, what is dividend payout versus dividend yield? And that's what we kind of covered a little bit, right? The dividend yields tells you the actual rate of return as far as a percentage in the form of a cash dividend to shareholders, versus the dividend payout ratio represents how much of the company's net income or net earnings are paid out as dividends, right? So some people say, hey, dividend yield, dividend payout. What's the biggest difference? The yield is for the actual shareholders. The payout ratio is complete reference to their net income of the companies, divided by the actual dividends that they're paying out, right? So dividends is a great way to expand your long-term portfolio, and for future aspects of dividends is you want to look in what's called the DRIP program, DRIP, right? And that's dividend reinvestment program. If you have a long-term goal of reinvesting some of those dividends instead of getting the cash back, what that does is now I buy more shares. So for instance, if I have 100 shares of a company and they give a 4% dividend, instead of me receiving $4 for every share or right that I own, or right, I now go back and I now buy or reinvest into more shares. So now I own 104 shares for the next earnings, right, for the next dividend payout. So now that 104 will get another 4% on top of that if that still stays the same percent of the yield. Now maybe next time I have 109 shares, and so forth and so forth. So another compounding effect. So a DRIP program, DRIP, dividend reinvestment program, is a great way to compound your dividends. So instead of receiving the cash, I can now reinvest it into more shares of the company for future compounding growth, right? So if you plan on doing long-term investments with dividends, make sure you use the DRIP program for that continued expansion and continued compounding effects.